Interest rates were just reduced by the Fed by 0.5%. Why do they do this? There's a couple of things that are concerning the Fed. That's why they did this. The Fed doesn't reduce interest rates because everything's going well. It's when there's something bad happening. They have to do this to try to reduce job losses. The gross domestic product, GDP, is starting to decline. They're also seeing that probably next year we're in the 1.3% to 2.5%. We're on the edge of a recession. The unemployment rate has gone up. They've revised it up from 4% to 4.4%. They think this can climb as much as 4.7% over the next year. The CPE, basically inflation, they're looking at, it went from 2.6. They reduced that down in September to 2.3%. They think inflation is pretty much over, but there's a concern that unemployment's starting to creep up. So what will this change? So the bond prices are going to go up. The bond yields are going down. Your savings interest rates are going to go down. Your new CDs, those interest rates are going to be lower. Your mortgage rates, if you got a new mortgage or refinance, it would be lower than it is today. The home price is probably going to go up because of the mortgage interest rate. When you go down by about 1% on a mortgage interest rate, the home prices generally go up by about 10%. So home prices and stocks tend to go up when you see a drop in interest rate, at least for a period of time, unless we hit a recession. If we go into a recession in, say, 2025, what you would see is declines in asset values. So that could be houses, stocks, pretty much any of those types of things. But generally, homes appreciate about 4% year over year over a long duration. If you find this useful, I cover a lot of topics such as how to make more money, how to save, and how to invest.